Where's the didn't pull it out. Okay. All right, well, thank you guys for showing up tonight. This is actually going to be the first of many lessons we're going to be hosting here at UVU. Always 8 p.m. on Wednesdays. Myself, I'm Ryan Anderson, originally from Iowa. I started learning to trade about 3 years ago. Met up with Steven about a year ago, and we started putting some really good trades together. This class, we're not with UVU by any means, and so we are a separate fund. But the reason we're doing this class is because it gives us an opportunity to bring our ideas together, really see what people are wanting to invest and how to invest, as well as sort of technical analysis. You could probably think back, I don't know if your parents, I remember my dad looking at stocks, and what did he look at to check his stocks? The newspaper. If he wanted to make a trade, he had to call a broker, get charged $50 to make a trade. So today we live in a day where information is available to anyone with real time. And that's what's allowed trading to really exist today. So we have an advantage. In the last 20 years, trading has really started to take hold. I actually graduated from UVU with an economics degree. The teachings in finance and economics are very, very similar. I will say the stuff we teach isn't available taught through schools. There is a lot of fundamental analysis where you look at sort of the whole accounting methods of growth of a company through their income statement and balance sheet. But the way we trade is a lot different from that. And it's a method that we've proven can actually make a lot better methods than simply the market return. And so we call ourselves Quick Trade. We just created the Facebook page today. Here we have just one of our trades today. We actually shorted this right here. Just Steven actually did that one with the break of the 5-day moving average, and already is up 5% on that trade. So our website, our Facebook site here, this is something you guys can join. It's actually, what's the link to it?
It's facebook.com/quicktradestocks.
Yep. And so on here, we want to basically answer any questions you guys have as we go through the classes, as well as we will put picks up here that are based on technical analysis. So there's certain patterns, and you'll be able to play those and kind of see what we do, because we don't want to say, look, we know what we're doing. We want to be able to show you and say, VIMC, this chart pattern, I alerted Steven 2 days before, and we waited for the right breakout, and then already 5% of the day. So these are the type of trades that we want to bring to you. This one has been on my watch list for over 3 months. And so there are ways, and it takes a little bit of work, but with that you can make some good money and some good percentage returns.
12% after hours.
It's down 12% or?
12% after hours.
Oh, nice.
More than most people make in a year.
Right. Yeah. Okay. And so why are we teaching a free class? I talked about that a little bit. Also, we've had a lot of our friends who said, you guys trade? That's cool. I want to learn to trade. And we get that a lot, and people are like, okay, well, maybe we can meet up sometime. We're not going to be able to teach our friend to trade in an hour. And with 10 or 20 people that honestly talk to me, obviously to these guys as well, trading is something where we said, you know what, we should just put a class together and be able to teach people, and once a week, and that way anyone who contacts us in the future and says, hey, I want to learn to trade, that's really cool, hey, come to our class, we do it for free, we teach you guys, answer any questions, and that's kind of what we've always wanted to do. So with that being said, I want to introduce John. John's sort of going to be the guy in charge of the Facebook page, so he'll be able to answer questions and sort of help any of you with any questions. Feel free to ask us about a stock, to analyze a stock, anything you want. We understand that once in a while you guys might have a great pick, and we're going to see it and we're going to be like, that's a great pick, and we're going to trade it. And so we really welcome sort of everyone giving ideas as well, and because when you guys learn to trade, you will see things that we won't see, and with your help, it'll benefit really everyone on this page. So, okay. The one thing I just want to show you is just this chart here. So trading in general is the idea of just making several trades over the course of time instead of investing just long term. We just put this together and we just did the math, said, well, let's say you started with 10,000. At the end of 1 year, after we decided to put a 35% tax. So it's realistic. We just don't want to say, oh, this is what you'll have. But at the end of 1 year, you'll have that 28,000. If you did this for 5 years straight, if you were to consecutively make trades with an average of a 3% return in a week, after taxes of 5 years, you'd have 1.8 million. And then you blew it all on boats and garden tools, apparently. So
I threw that in right before class.
yeah. So, but I mean, you can see all the numbers. As you paid the 35% tax, it got taken out from 43,000. America's going to take your money too. So, but eventually, you can kind of see the growth. So over a 5-year period with 10,000, if you were to master trading at 3% a week, you can have $1.8 million cash. That's after taxes. And so that's why people want to trade. And with technology today, we live in like the first generation where you actually can trade with real-time information. You can be on your screen viewing trades going through. When we were growing up, it was just, my dad looking at the newspaper and be like, oh, my stock's down again. What should I do, boys? That's done with. Real-time information is what allows traders to really take this to the next level. The main person teaching this class will be Stephen King here, not the author. Well, he might claim a couple books if they're. But he's really a trading expert, and I've learned a lot from him, and that's why he's going to take us through some of the basics. Everyone's at a different level, and so there's some things we might say today that you'd be like, I have no clue. There's other things you'd be like, okay, that makes sense. But everyone's going to be at a different level, and we want to take people and really start at the beginning. Talk about why trade, how to trade, what to trade, and go through all that. But with that being said, Stephen, you can go ahead and introduce yourself a little bit more and take it away.
Okay. Thanks, Ryan.
Don't need that up now. So that's for some notes class. But yeah, like he said, I am Stephen King, and I have been trading for the past 13 years. And in that time, I have learned quite a bit, and it's just my hope to share some of that knowledge with you guys in the meantime. And like Ryan said, some of this stuff is going to seem, just to piggyback off what you said, some of this stuff is going to seem kind of like, wait a second, 3% a week? Are you kidding me? I mean, my broker told me I can only make 8 to 12% a year. You're talking 3% a week? That sounds insane. Like, are you on meds? No, what he's saying is, we now live in an era, we live in a time that no other generation has lived in before with high-speed internet. If you think about it, when we were kids and we had to get on AOL, and it was dial-up and stuff like that, we couldn't get that real-time information. Doing this type of trading was totally impossible. But now it is possible, and I started 13 years ago, right when it was just starting, and so I've kind of been at the forefront ever since then. I had a lot of success. As a matter of fact, I used to skip high school freshman year. My dad would drop me off at school, and I would walk into school, out the back door, and over to Starbucks, where I would hook up to my laptop, and I took the $1,200 that I made from my summer job, and just kind of sat over there and started trading. And my dad was upset when he found out that I dropped out of school freshman year because I couldn't pass Algebra 1 in high school. But he wasn't upset when he looked at my account, and it was up just a little over $250,000 on my 18th birthday. So if one of your questions is this hard? My response would be, it's not difficult because I could not pass Algebra 1, but I could make a little bit over $250,000 that year. So who knows what that was, dumb luck, but I don't think so. It's hard to have that much dumb luck in a row. So with that being said, I'm going to go ahead and just kind of get into the basics of things. Now, at the very beginning of class here, we're not going to just jump right into how to trade stocks. That's kind of, I don't know, you know, those phrases people use, like that's doing something before you do something else. I'm not good with analogies, but what I want to do is,
And walk before you run.
yeah, there you go. Class participation. See, you get a kiss. There you go. I give kisses for class participation. So anyway, you got to walk before you run. So what I want to do is I want to pose a question. Because if we're going to start trading and we're going to start making money, we've got to start thinking like people with money. Hey there, welcome. How's it going? Not bad. So, I want to pose a question. Do you guys think that the poor and the middle class think of money differently than rich people do? Anybody? Yeah, I want to talk about some of those differences and just kind of ponder that question for a minute. The poor and the middle class, we've all heard the stories, right? That like somebody wins the lottery, and I'm not talking about like $100,000. I'm talking about like the jackpot, hundreds of millions of dollars, and they're not poor, they're kind of middle class. They're okay. What usually happens to them in about a year? They lose everything. They lose everything. They usually either end up completely broke, bankrupt, or dead within a year. Those are the statistics. That's interesting, right? That's interesting. Now, rich people, on the other hand, if I were to think of an example of somebody that was rich and lost all their money, like Donald Trump, who lost everything back in 1987. As a matter of fact, in 1987, he went in debt $900 million. He remembers walking out, I read in his in a biography, it was a cold, rainy evening in New York, and he walked out of Trump Tower, out of his office, and he looked around on the street, and a homeless guy asked him for $1. And he looked at the homeless guy and he said, "Sir, you are $900 million richer than I am right now." And that was in 1987. In 1993, he had not only paid back that $900 million, but he had also made $5.5 million. And as we all know today, he has way, way more than that. That's interesting. He must think differently about money. Warren Buffett, when he first bought Berkshire Hathaway, they went completely out of business. Today, Berkshire Hathaway, they're like one of the most or the most expensive stock traded on the exchange today. It's like over $10,000 a share. Very interesting. What separates these people? Levi Strauss goes out to California to mine for gold. Can't find anything, can't find an ounce of gold out there. But notices that people are starting to run out of clothes, so he makes some comfy pants, and we've all heard of Levi jeans. Thomas Edison, one of my favorites, didn't actually invent the light bulb. I think that was somebody else, right, who actually invented it, but he was the first one to successfully invent a marketable addition. And it's said that he failed 10,000 times before he succeeded, right? I'm seeing some nods in the back like that's correct. That blows my mind. The guy fails 10,000 times. Now, there must be a difference in the way these people think versus the way, like, say I was brought up, you know, somewhat middle class. With these people, I think there's a lot of differences. One, I think, has to do with education. Like Ryan was talking about earlier, there's nowhere you can learn this stuff. There's nowhere you can go to learn how to have a rich mentality. You have to kind of just be born that way, or maybe read a lot of books, but you can't go to school. They don't teach it in school. When you go to school, they teach you how to be an employee for someone, right? You got chemistry, you got physics, you got mathematics. They're teaching you how to work for someone for the rest of your life. You're not learning how to own your own corporation. And the first thing you learn in school, you're taught a lesson, you take a test, and then you pass or fail. If you fail, You made a mistake. That's bad. We learn that immediately. That's bad. It's bad to make mistakes. Rich people think differently. Thomas Edison failed 10,000 times. We look at him and go, brilliant. Interesting, right? Interesting that we're taught from such a young age. This is so ingrained into our mind that failure is bad. And let me tell you something. When you start trading, better get used to failure, because it's going to happen. It's going to happen to all of you. And it's going to happen a lot. And so where I'm going to take you guys is, we're going to look at some of the differences between the way that the rich and the poor and middle class think, and then we're going to look at why that's important. Did anybody's parents ever say to them as a kid growing up, we can't afford that. We can't afford that. But it's like, Mom, I want to go to Disneyland. And they say, we can't afford it. You know? John goes, Mom, I want a Barbie. And Mom goes, no, we can't afford it. Rich people don't say that. Rich people say, how can I afford it? And I know that may seem simple and trite, and maybe like a little like you're playing with semantics. But that's not true. Because when you say, I can't afford it, you're turning your brain off. That's mental laziness. All of a sudden, you don't have to think about it anymore. When you say, how can I afford it, your brain is constantly going. You're constantly trying to come up with answers. You're constantly coming up with solutions. There's one way that the rich think differently about us. I know that I was told growing up, you need to go to school, you need to get good grades. Why? So you can find a safe, secure job, right? With benefits, because that's not risky. That's not risky. Then you get in, and it's all about climbing the corporate ladder. The rich, that never crosses their mind. They don't want to climb a corporate ladder. They want to own the ladder. This is the paradigm shift that we're going to have to start making while we start trading. Because if we don't, we're going to end up like those people who win the lottery, and all of a sudden you're going to have a lot of money, and you're not going to know how to manage it. Another thing you'll hear, this is risky. This is so risky investing in the stock market. Oh my goodness. Your friends will say, what did you do last night? Oh, I sat in a class where we were learning to trade about stocks. And they'll go, well, that's risky. Really? Is it? Okay. Well, let's take a look at that. I don't think it is risky. I think what's risky is financial illiteracy, which is what we're here doing tonight. I think what's really risky is if you've got a job and that is the sole source of your income. That's risky to me. If you have no other sources of income coming in, I don't know. Which one's really risky? So what they'll tell you is, no, I'm smart. I save. I do savings. I have a savings account. With the dollar and other global currencies decreasing in value, your currency is worth less and will buy less in the future. On top of that, the interest you are paid by the bank for your savings may earn you less than the fees and expenses that you have to keep your money in the bank. By saving money, in almost all cases, you are losing money. Would you call that a safe investment or a risky investment? I'd call people who save risky. An investment that consistently loses money is a liability. And as we'll talk about in a minute, that's the difference. That's the formula. If you want to be rich, rich people look for where to buy assets. The poor and the middle class look for what liabilities to buy next. Then you might get somebody who's really smart, and they might say, well, I don't put my money in savings. I have a 401k. I'm invested in a mutual fund. I have an IRA, so I'm taken care of. Let's look at a quote from John C. Bogle. He's the founder and CEO of the Vanguard Group. I'm not sure if anybody's heard of the Vanguard Group before, but if you have an IRA or you have any kind of 401k, I'm sure you've heard of the Vanguard Group because that's basically the one that you get put in. This is what he had to say. He said, well, and I'm quoting, "It's awesome. Let me give you a little longer term example I use in my book of an individual who's 20 years old today starting to accumulate for retirement. That person has about 45 years to go before retirement, 20 to 65. And then another 20 years to go before death mercifully brings his or her life to a close. So that's 65 years of investing. And if you invest $1,000 at the beginning of that time and earn 8% a year, that $1,000 in that 65-year period will grow to be $140,000. Not bad. So's all your friends. Now, the financial system, the mutual fund system, in this case, will take about 2.5 percentage points in fees out of your return. So you will have a gross return of 8%, but a net return of 5.5%. And in that 65-year period, your $1,000 will instead grow to approximately $30,000. $110,000 goes to the financial system, and $30,000 to you, the investor. Think about that. That means the financial system put up 0% of the capital, took 0% of the risk, and got almost 80% of the return. And you, the investor, in this long time period, an investment lifetime, put up 100% of the capital, took 100% of the risk, and got 20% of the return. This is a financial system that's failing. And you're getting financial advice from stockbrokers. These people are salesmen. Some of it's hidden, some of it's in plain sight. The mutual funds, the managers, they make money whether you do or not. They can care less. They are not concerned about the performance of your fund. They're mainly concerned about your fees. Now ask yourself, is that risky to be invested in something like that? What's really risky here? So, I would say the definition of really risky is having no financial education. Blindly turning your money over to a financial planner or advisor, not understanding the investment and the returns on the investment, putting up the majority of the money and the risk, and letting others walk away with the majority of the returns. Having no control in your investments and depending heavily on your financial advisor, and that's exactly what you do anytime you're not investing for yourself. Now, what do we want to learn how to do that's so risky? We want to learn to get financially educated. We want to be actively investing our money and gaining hands-on experience, understanding the investment and the returns on the investment, putting up the majority of the money and the risk, and getting the majority of the returns, having control of our own investments and becoming our own financial advisors. So, one of the last things that I would say about how the rich think differently about money is, they never sit there and talk to their kids about going off and getting a job and working for money. To them, that is an absolute foreign concept. The rich do not work for money. They make money work for them. Just as you saw on that slide that Ryan had up there, he started with $10,000, and then after the first week made that 3%. So essentially what you've done when you've invested $10,000 is you've now got 10,000 employees that work for you. Those are your employees. And every week they're making 3% for you. And then you've got more employees. You've got 3% more employees working for you. You think of this, you gotta think of this as like a business. Now, as a middle class and growing up as a middle class, I have to get myself out of this mentality that's like, sweet, I just made a 20% gain. I should totally take some of that out and buy myself like, you know, I don't know, something as a reward. All right, sounds good. That's smart. Shoot your employees in the face. Essentially. Because here's the formula. This is the formula. If you want to know how to get rich versus staying middle class or poor, it is as simple as this. Define an asset versus a liability. The way I define an asset is anything that puts money into your pocket. A liability is anything that takes money out of your pocket. The only difference between the rich and the poor is the rich want to buy assets. they are constantly on the hunt for how they can buy new assets, new businesses, stocks, real estate, whatever. That's what they look for. How can I buy a new asset today? And that's what makes them rich. What makes me middle class is I constantly look to buy liabilities. I go, man, that's a cool MacBook Air. I think I need that. That looks like an asset to me. It's a nice shirt. I think I'll pick that up as well. You know, kind of look fly. But that's the difference. And that is the formula to be rich. If you want to be rich, all you have to do is start buying assets and start limiting buying liabilities. And that's why we're here, guys. That's why we're here. We're here to talk about buying assets. Now, essentially, the thing that I was leading up to was this. We're going to talk about how to trade stocks. Okay, that's what this whole class is about. That is a how to get rich. In my opinion, it's the one that's worked for me. You want to become a millionaire? I think that's the quickest way to do it. You know, I know from experience that you can make some money in a fairly short amount of time. You can also lose money. It depends how disciplined you are, and we'll talk about that at some time later. But that's the how. Now here's the important part, and this is the part that I was getting to. This is the home run. This is the part that you got to think about. It's not the how. It's not the how. There are a million hows out there. I could tell you a million ways to make $1 million. You've seen them, Shark Tank. You've seen it, the guy with the pet rock. There are a million hows out there. It's not the how, it's the why. It's the why do you want to do it? Because you see the kind of paradigm shift that you're going to have to change in your thinking, and how frustrating it can get sometimes after you lose 4, 5, 6 trades in a row, and you wake up and you're just like furious. You got to have something that keeps you going. And I'm here to tell you, it might work for you, but nice cars, nice houses, stuff like that, that might motivate you. That might motivate you, and it might be a good why. But for me, that doesn't work. For me, my why is I want to have a great family one day. I want to be able to take care of my parents when they get older. When I have kids, I don't want to have to ask the nanny, oh, they took their first step today? What did that look like? Oh, they had their first day at school? What was that like? Did they make any friends? What are they doing? Oh, now they're going off to college? Oh man, I don't want to miss my life. I don't want to miss my life. I don't want to sit there and be owned by another human being who owns my time and who keeps me stuck in this little corner of the United States, this little piece of the world. I want to get out there and travel the world with my family. I want to be able to show my family all of the creation that was made for us to enjoy. I think we were made to enjoy it all. I personally also would like to help people. I'd like to leave a mark on this world. I'd like to one day create a not-for-profit hedge fund that when I die, it lives way, way longer after me. And that way, you know, in that way maybe I can leave some kind of handprint on the planet that really changes people and that really, really can stop some hurt and some suffering and a lot of the pain that's going on this planet. Now, that's my why. I have had so many frustrating days where I've wanted to quit this, where I've just said I've had enough of this. Then I think about my why. So I'm here to tell you right now, the how is not important. The how, we got that taken care of. The how's easy. I'll teach you how to do the how. Come up with a why. If you don't have a strong enough why, you will never meet it. Okay? With that, we're going to actually start getting into a little bit of the trading part. Sound good? Ryan, let's see. I wanted to go to probably the slides, yeah? Sound good? Okay. We'll go over these really quickly. We definitely don't want to keep you guys here too long tonight. I know that sometimes this stuff can burn you out really quick. So, you know, we wanted to try and hold these classes to no longer than 40 minutes for sure. because I know there's a lot of stuff to digest. But we're starting for beginners. I see you smiling over here because he's traded before. But, you know, some people, they're like, that's cool, I want to learn to trade. But what's a stock again? So a stock is basically a company, like IBM Computers, for instance. And each company has a symbol. For instance, IBM is just as simple as IBM. Google's symbol is GOOG. Amazon's symbol is AMZN. Look at me, I know my alphabet. Anyway, that's the way you look up companies and the quotes on the internet. You use their symbols. So each company out there that has a stock has a stock symbol. So you can buy and sell shares of these stocks. Now, what is a share? Say I want to buy some shares of Amazon. Well, you can think of it like this. Pretend a share is like a baseball card. What's like a good baseball player right now? I'm not too up to date on ones.
If you've got like a Babe Ruth card, that's gonna be
A Babe Ruth card. Okay, say a Babe Ruth card. Okay, say Amazon. Amazon is a Babe Ruth card. I own one Babe Ruth card, and it's worth $5 or something like that, right? And my Babe Ruth card is worth $5. Say I've got $50. I can buy 10 Babe Ruth cards or 10 shares of Babe Ruth or Amazon, essentially. Now, say all of a sudden that some crazy news comes out and we find out that Babe Ruth back in the day was doping and you know, and then he did this and he cheated on his wife and he did all this horrible thing and now everybody hates Babe Ruth. Or something bad happened in the company, like the CEO did something terrible, he cheated on his taxes or something like that. The price of my baseball card might go from $5 to $2. Now all of a sudden, I have these 10 Babe Ruth baseball cards and they're only worth $20 instead of the $50 that I paid for. So that's kind of what a share is like of a stock. Does that make sense to everybody? Or is anybody just kind of like, what the heck? And remember, there are absolutely no such thing as a stupid question, just stupid people. So, I know, I'm totally kidding. Really, did everybody follow that? Or is anybody still kind of confused a little bit about what a share is? John, you still confused? John's always confused. Okay. Cool. Oh yeah, I forgot I can't memorize this. And if you are, don't ever hesitate to come up to me after class and we can talk about this stuff. What is a chart? As simple as that might sound, it's really important to us because basically, like what Ryan was talking about, up until very recently, we had to use two different ways of investing. It was fundamental analysis, which basically was like you look up, you know,
Income statements, balance sheets, kind of.
yeah, income statements, balance sheets, the stuff about the company. I don't use that anymore. We use charts to invest these days, so we read charts. But anyway, this is basically a chart. You can see along the bottom, that's the time frame. And you can see along that side, that is the price of the stock. That's the price per share. So at this time, the shares were worth $85. At this time, they were worth $115. Okay? They go up to $135. Then maybe something bad happened, and all of a sudden they're worth $90 now. So this is the price movement of how much your shares are worth. Does that kind of make sense to everybody? Okay, I'm getting some kind of maybes out there. Okay. All right. Is everybody doing okay? Is everybody tired? Do you guys want to hit this next week before we get into this? There's about 10 slides. We can wait till next week if we're tired. I don't know. Okay. All right. I'll try and get through this here in the next 10 minutes. Okay. There are different types of charts. Well, hey there, Mr. Dave Wilbur. How are you? There are different types of charts. What you just saw back here is called a line chart. This is the OHLC. That stands for open, high, low, close. These aren't typically used, but you'll see them. So I know this looks a little weird, but what this represents is this represents one day. Each line represents one day. The top of this line is how high the price went that day. The bottom of the line is how low the price went that day. The little dash coming out to this side is where the stock opened that morning. And the little dash coming out to the other side is where the stock closed that day. If it's black, it went up, as we can see, because it opened here and closed there. And if it's red, it went down. We can see that it opened there and that it closed there. Now that tells us a lot more information about a stock than just a little basic line chart. We can actually see what it was doing all day. Now, there is a better chart that was evolved, and that's called a candlestick chart. It's very similar to the way that works, but this is what we use, and these are the only charts basically that we'll be looking at here. Because again, we invest based solely off charts. I mean, sometimes we'll look at fundamental analysis and what the company's doing, but I personally don't care what the company does. I don't care what they make. I don't care what their sales were. I don't care anything about it. I care what the chart pattern looks like. And what I'm going to show you is that there are different chart patterns that when we see them and recognize them, we know a significant move is coming. And we are typically right most of the time. But if we're wrong, we cut our losses early. We never risk more than 2% of our account value. And on our winners, we let them run. We let them run. And that's the way we're able to make gains. But the candlestick chart, you can kind of see it up there. A white candle represents a day when the stock price went up. You can see where the bottom of the candle is where it opened, where the top of the thick part of the candle is where it closed, and then the little, those are called shadows or wicks. That's the high and the low for the day. And if the candle's black or red, it's the same thing except it opened up top and closed up bottom. Does it make sense to everybody? Yeah, kind of? Okay, so we can tell right here, this was a really big down day. This big, long red candlestick, where did it open? Right there, right? And it's red, so that means it closed down here. So it fell that day. But before it fell, it rose that high. And then it fell. So we know for the day that for that day, the chart kind of looked like this. It opened, it went up a little bit, it went all the way down and closed down there. So that actually gives us a lot of information about what the chart is doing. It gives us a lot of information about supply and demand. Like when we see that the price has been going down for a while, and then all of a sudden we see that this is a big long white candle and it opens down here and closes up there. Well, that means that the price opened down here, went all the way down there, but then a bunch of buyers stepped in and drove that price all the way up there, and it closed up there at the end of the day. Now that tells me there's a lot of buyers now interested in this stock. And it just so happens that the stock price soars after that. Isn't it interesting that we can tell a lot about supply and demand just based off of a little candlestick? Can you see why that's a little bit more useful than just a little line chart? Yeah. Now, the way technical analysis works, which this is called technical analysis, the way that I invest, it's based solely off chart patterns. Like what I was saying earlier, we do not care about what the company does, because what I believe personally is, I believe that everything about the company it's already public, right? It's already known to everybody, and so that's already built into the price. All the information about the company is already known. So the price is where it should be. When somebody says, no, but their earnings next quarter should be really, really high, and therefore the price, it should go up. No, everybody already knows that. And so that's already built into the price today. So my theory is that the only reason stocks move is based on what charts look like and what patterns are setting up. So that's why we trade based off charts. Oh yeah, this computer. Okay. the next thing we'll talk about is something called support. There's a really interesting phenomenon that happens sometimes. When a stock price goes up, and then it comes down, but it doesn't go below a certain level, and then it comes up again, and it doesn't go below a certain level, and then it goes up again and approaches that level, and then again, and then approaches that level, and approaches that level, and approaches that level. It's like, hey, seems to be a pattern going on here. For some reason, it does not want to dip below that. So I wonder how we could use that in investing. If we could figure out where support lines are, then when the stock came down here and tested support for the third time, and it started bouncing up, I'd say maybe that's a good time to buy. And look what? It did. It was a great time to buy. And so that's why we identify support levels, okay? Now, support levels can be broken at any time. And any time a support level is broken, if we were to see the price fall below that support line, that usually means that the price is going to be headed down big time. And so that's when we would want to get rid of the stock if we had bought it. Now, like support, there's also something called resistance. You see the support line down here, and you see the resistance line up here, because every time the stock gets up here, it just can't make it higher. At looks like $75.50, you know, the sellers step in and they say, look, the stock, I can't pay anymore for it. And so then the sellers will step in, and then it'll come down to about $60, and then the buyers will step in and say, wait a second, it's worth more than this, so they'll step in. And so it'll get caught between these price channels of support and resistance. And one of the major things that we do here is we try and identify support and resistance lines, which can go all different directions. They can form wedges, they can form outside wedges that go this way, they can form all kind of patterns, right? And we identify these patterns and we trade based off of which, if it's coming out of its resistance or its support. Because something that not a lot of people know about, that I'm not going to really touch on today, it's called selling short. It's a little bit of an advanced concept. I know some people may be aware of it, but it's the opposite of buying a stock. And so if you sell a stock short, you actually make money if the stock goes down. That's why during market crashes, I can't wait for the next market crash. I'm going to make 5 times as much money in half the time than I would have during an up market. So some people are going to be like, yeah, but you're investing, you know, but the market could crash any time. Good. A good investor makes money when the market goes up, but a master investor makes even more money when the market goes down. And we're going to teach you about that. Okay. One of the cardinal rules in technical analysis is that whenever a resistance is broken, it becomes a new support level. So as we see here, it was resistance, it came down, it tested it 1 day, it tested it 2 days, the 3rd day it finally broke above that resistance level. Technical analysis states that this now, instead of a resistance level, is a support level. So let's look at what the price did. It comes down, boom, support. It bounces, boom, boom, and takes off again. So whenever we see a resistance level broken, it becomes support. Can you spot if there was an upper resistance on this chart? Can you spot where it would be? Anybody? Want to take a stab at it?
Yeah, like at the top over there.
Where at?
Like the next resistance? Or just at the top?
At the very top, like
Yeah.
around what price?
Like 1150. Something like that.
Yeah, right up there, right around 1150. So that is where the new resistance would be. Do y'all see that? Because it's come up and it's tried to hit it there, it's tried to hit it there, and it's tried to hit it there. Now the chart doesn't go further, so we don't know what happens, but anyway, so okay, there you go. You're now learning how to spot support and resistance, which is such a big deal, you don't even know. what happens when we break resistance? We already touched on this a little bit, barely, but here is a resistance line that was drawn, okay? And like we said, whenever resistance is broken, no good. We don't want to be in that stock, so we sell it right away.
I mean,
what
support,
happened?
right?
Support, I'm sorry. Sorry, yeah, support. Yeah, I get, thank you there. If I ever get, please do. Thank you. So yeah, so we'll get breakdowns a lot of times when that happens. And so now I'm gonna get it right. Resistance, you've got resistance here, okay, because it tries to break, tries to break, tries to break. Now look here, it broke just above the resistance. I would be, at this point, I'd be looking at the stock going, oh my gosh, it just broke its resistance. I better get in this right now. Now what would have happened if I had done that? The stock would have gone from $48 and it would have gone to a high of $61 and started trading in this range right here. Interesting, huh? That we don't have to look at news announcements and financial reports and all that other stuff that everybody's had to do for ages now. Now we have the internet and we've got these real-time charts and we found out that they behave in certain ways that are predictable. Interesting, right? Interesting. We're close to the end. What happens when we break resistance? I'm not sure where we were going on that, but okay. Obviously we can tell, and I'll just kind of, for the record, I'll draw this. This would be a resistance line right here, right? And so right there it breaks resistance, correct? Because this is a resistance line and it goes across. Now it breaks resistance right there. What happens when resistance is broken? It turns into
Support.
Exactly. And look what happened. It turned into support. It bounced off. Okay? Then this is the new resistance, right? So we'll draw another line here. What happened when it broke this? Boom. Interesting the way this stuff works and how predictable it becomes. When you can look for charts all day long that are right there at these setups, and you can literally make these trades, it's not so hard to believe that you can make 3% a week on something like that. As a matter of fact, because that's the end of the PowerPoint presentation, we're just going to show you one last thing. We had a really fun trade last week. It was Sprint. Everybody know about Sprint? So I work for a hedge fund, and the guy that owns the hedge fund, the CEO, he's more of a fundamental guy. He bases stuff off numbers. He doesn't base stuff off charts. A lot of people that have traded for a while do not believe this chart stuff works, which blows my mind. But I called him right there when the price was at $5.75, and I said, you might want to take a look at getting in Sprint right now. And he emailed me back and said, Sprint's dead money. Sprint is dead money. You're dead meat if you put your money in there. But this is what me and Ryan saw. Let's zoom in just a little bit. What we did, let's get a trend line going here, was I drew the resistance, which was right here. That would be our resistance line. And then I'll take the low and I'll draw the support line. And what you have here is called a wedge. What the price did was it bounced back and forth between this wedge, and if it hadn't broken out to the lower side, we would have known that the price would have fallen. But what it did was it broke out to the upside. And so what did the resistance do? It became support. And it tested it, and when it bounced, we knew that it was about ready to jump. And so we got in on this day, and it went from, what, 580, and we sold right up there at 710 for a 22% gain in 3 days. And that was last week?
That was 4 days. but,
Yeah, 4
Don't
days.
lie to anyone.
Yeah. Sorry, whatever, 3 days, 4 days, I don't know. So, the CEO emailed me back and he was like, yeah, you know, good trade. So I'm not sure why people doubt that this stuff works, but this right here, this particular wedge setup is just one of many that we're going to teach you guys about. But that is a particularly strong pattern. Whenever we see a wedge like that, and then it breaks upward, comes down and test, we know that there's about to be a significant move. About 80 to 90% of the time, it happens. So anyway, that's kind of a crash course on what we do and what we're going to be teaching you guys. And there's a real life example of how we made 22% last week. Unless anybody has any questions, we hope you enjoyed tonight. And we'll be sticking around afterwards. You're welcome to come up and talk to Ryan or John as I run out the door. No, I'm just kidding. Hope you guys enjoyed it. And we're going to be meeting next week at 8 o'clock. Again, be sure and bring your checks for $1,500. No, like you said, we're doing this for free because, you know, it's just what we're doing. When you have multiple people scanning the market that understand this information, there's a really good probability that one of you guys is going to call me one day and say, hey, Stephen, did you see this chart? And I'm going to say, no, I was on a beach in Cancun. And I'm going to go and I'm going to go in and I'm going to look at that chart and I'm going to go, oh, cool, buy. And then in 20 minutes, I'm going to make 22% because you found it for me. Thank you.